Greetings, everyone. I hope you had a wonderful holiday season and a nice Thanksgiving. We are back in the saddle with our November video commentary review. So this series is going to be a little shorter, and what we're going to do is make the monthly commentaries a little shorter and then go deeper on quarter ends and year end. So I hope you enjoy this. I think we have some good stuff to share today. We'll look at month to date, how November did as far as financial markets go, how 2022 stacks up with history. I'm getting a lot of questions about how this bear market stacks up with other bear markets, most notably the late 70s and early 80s. We'll look at global bond yields and why peak inflation is so important and could unlock an inflection point. So let's get into the charts. So this graph might be hard to see, but this is essentially a snapshot of various equity asset classes. And I threw a bond index in here as well. And you can see, for the most part, I don't need to get into these acronyms, but for the most part, November has been positive across the board. And there is an outlier here, which is nice to see. And keep in mind, I am recording this on Tuesday, November 29th. So if you're looking at this a week later, a couple days later, these numbers might be different. But what I want to point out here is emerging markets in green and international developed are breaking out relative to US equity markets, which is really nice to see because these two equity asset classes have been beaten down relative to US stocks for some time. And it's going on a decade plus of US equity outperformance relative to international markets. So when you're looking at the opportunity set of investments and looking to allocate capital for the future, we've been pretty adamant about placing calculated bets on international markets, and it's nice to see that outperformance. When there's smoke in the streets, when there's blood in the streets, that's a good time to look at some of these beaten down markets. And remember, markets move in cycles. What's had their day in the sun might not perform as well going forward. Think tech in 2022. What's been out of favor could have their day in the sun going forward. Think energy 2022. Energy stocks no one wanted to own for 15 years, beaten down, out of favor, and all of a sudden they've had their day in the sun. So this is not a huge portion, a huge allocation in our equity asset allocation, but it could become a bigger piece. And we actually added to international markets last month. So it's nice to see this outperformance. This is an interesting graph, one that I like to revisit at the end of the calendar year. So we're approaching the end of 2022. This data set is as of the end of October. And basically what this is, it's a distribution of historical stock and bond returns. So each number represents a year here, and we don't need to get into the individual years, but this goes back to the late 1800s. Okay, so this is like 150 years of market data. And what this is just stacking up calendar year returns. So if 2022 were to end today, this is the US 10-year Treasury total return. It would be the worst year ever for the US 10-year Treasury total return. So that's ugly stuff. And then looking at equity returns, this year has been ugly, one of the worst on record, but it's not the worst ever. So if the year was to end October 28th, 2022, this is where 2022 would stack up for the S&P 500. And so there's a couple takeaways here. One, I think it's important to recognize where the frequency or distribution of returns stack up. What is the most common rate of return for the US 10-year and the S&P 500? So if you're looking at this, this was a 0% return for the US Treasury 10-year, US 10-year Treasury. And this is 5%. So we can see that the most common return is 0 to 5% for the 10-year Treasury, right? If we were to stack these two bars up, it would be by far the most common return. And even going to up to 10%, if you were to stack 0 to 10% returns, that would make up most of the distribution. And again, just to give some context how bad 2022 is, this would be an extreme outlier on the bad side. We don't mind extreme outliers on the upside, although these outsized returns often follow nasty, ugly years. So, if you lop off some of these outliers, again, you're looking at the most common returns for the 10-year Treasury bond to be between 0 and 10%. Conversely, for the S&P 500, again, if we're looking at the most common returns, most of the distribution falls between negative 10% and plus 30%. And one thing that's important to note for perma bears or pessimistic people is this is a positively skewed distribution, meaning most returns are skewed to the positive side, right? So again, you can't set your watch to this. You're going to have some ugly years, as we can see here. But if you're stacking up 150 years of data, this is definitely a positively skewed distribution, which means the majority of the outcomes are positive. Okay, so that's good for context. Getting a lot of questions about where this bear market stacks up relative to other bear market cycles. And I don't know the answer. No one knows the answer. But this is a neat look at 2022 versus all bear cycles since 1950. Okay, so what this is the percentage drop from peak to trough, and this is months down here on the bottom. So percentage drop from high mark to trough, bottom mark, and I believe this is the S&P 500, and then months, right? So the further we go, the more deep we go on the downside, the more ugly a bear market is, and you can see some of these ugly long bear markets. So anything in the southeast corner is ugly. Anything in the northwest corner up here would be shallow on the downside and short, speaking in terms of months. So where are we in 2022? And this is as of the end of November. So this is pretty current. And you can see we're about going on 10 months in this bear market, and peak to trough, we were down about 30%. So when we look at that since 1950, this has been longer and deeper than a lot of these bear markets. If you look at the distribution of the bear market peak to trough and then in length, a lot of this cluster is closer to the northwest corner. So bear markets are usually short and sharp or long and shallow. And there's a big cluster in short and sharp, and probably the shortest and sharpest in recent memory has been 2022. And you can see this is an outlier for the condensed period, but it was pretty violent on the downside. So aside from a few of these years, 1973, 2000, 2007, 2022 has been deeper and longer than a lot of these bear markets. So some point to this and say we're closer to the bottom or we're closer to the end than many of these other bear markets. So that could be an inflection point, just the sheer length and depth on the downside of the 2022 bear. But again, you can't set your watch to any of this. This is just context and evidence. We're a fan of that, as you know. Let's move on. So there's a lot of hot recession talk out there, and yield curve inversions tend to be a really good indicator if we are in a recession or if we are about to be in a recession. I believe this yield curve inversion tool as a forecasting tool is pretty much undefeated, meaning it's batting 1,000. So if we're not already in a recession, this is basically signaling that we could embark on a recession in the coming year or two. So what this is basically short-dated bond yields minus longer-dated bond yields. And when shorter maturity bond yields are higher than longer maturity bond yields, that tends to indicate signs of economic stress. And you can see in the US here, this light blue line, we've been inverted for some time. So we've been inverted for a good part of 2022. This dark blue line is a snapshot of global bond yields for the 15 largest economies in the world, and this just inverted. So it's important to note that many of the global central banks are playing a variation of the same game. They are increasing short-term yields, short-term rates to pump the brakes on their economies, to snuff out inflation. The US has led the charge, and this is reflected in this graph where we've been more aggressive raising rates. Global central banks are following, but they're slightly behind. So this is interesting. This is indicating that the US could be in a recession or is about to enter one, and global economies are a little bit behind, but it looks like if we do get a recession, it might be a global recession. And look, there's a lot of negative connotation around a recession. In our opinion, All a recession means is market participants, investors change their appetite for risk. So during good times, someone would seek risk. During bad times, someone might shun risk. And I think that manifests itself with the people that we talk to. Like during good times, they'll say, okay, I'm going to take out a loan. I'm going to build this apartment building. During bad times, they'll say, hey, let's just wait this out. I don't want to take on risk. And looking at the evidence, looking at bear markets with a recession, bear markets without a recession, two things stick out. One, equity returns are slightly worse. You're looking at every bear market with a recession, every bear market without a recession. The equity bear markets with a recession tend to be a little bit worse on the return side. So about 6% worse compared to bear markets without a recession. So all that means is if we do get a recession, equity markets tend to go down slightly more than if we have a bear market without a recession. Okay. On the other side, bear markets tend to be a little bit longer with a recession. Okay. So the key takeaways out of all of this, a lot of talk about recessions and what it means. It tends to scare people. Equity markets tend to do a little bit worse. The bear market tends to be a little bit longer. That's the main takeaway. It's not some Armageddon thing. It's not the world is burning. And I hear a lot of narratives about the collapse of this and the collapse of that and the end of the world as we know it. Historically, again, looking at 70 plus years of data, a little bit worse on the downside for equities, a little bit longer for the bear market. Okay, the Fed is all over the news talking about the terminal rate, the normal rate, the benchmark rate, whatever you want to call it, is higher than most people expect. And this does move markets. The Fed has been very keen and aware to manage market expectations through their language, through their press conferences, through their daily musings. And in my opinion, it's getting a bit out of hand. And for better or worse, I don't know if it's a good thing or a bad thing that the Fed is horrible at forecasting. If you look at what they were saying about inflation in 2021 and what they're saying now, I mean, they've basically missed the mark every step of the way. So the Fed can say whatever they want. The Fed can talk tough on inflation. I've shown this the last 3 or 4 months that I've done this commentary, and the market is basically calling their bluff. So looking at the futures market for the Fed funds rate for the December meeting, it's basically saying there is almost a 68% chance the Fed is only going to hike by 0.5% instead of 0.75%. The Fed's hiked 0.75% the last few meetings. The futures market is saying the Fed is going to slow the pace of hikes because, as we've seen, we're starting to get a normalization of inflation. We've talked about that a lot. A potential inflection point is the normalization or a natural ebbing of inflation. That's starting to happen. It's starting to show up in the CPI numbers, but this is a very slow process. Inflation is backward looking, but this is very interesting to us in that the market is pricing in and calling the Fed's bluff and saying the terminal rate might not be as high as the Fed is saying. It could be lower. Okay, the next positive sign would be for the Fed to actually pause. And it looks like we are, in our opinion, we're closer to a pause than what the Fed is saying. This chart backs that up because it doesn't go from hiking 0.75% to pausing. They'll probably normalize or slow their pace of hikes, which could lead to a pause. And we talk about it a lot, about a natural ebbing of inflation. And you might ask, Nick, why does that matter? Okay. So we're going back to late 60s, early 80s. This is the period that the Fed is watching very closely and comparing that to what's happening today. So think back to the early 70s, early 80s, market period of wild oil prices, high inflation, and the Fed was doing all they could to snuff that out. But there's an interesting trend here, and I'll point that out. So what this is, the blue line is the S&P 500, and this goes back to 1968 all the way up to 1981. Blue line is the S&P. The red line is the annual CPI inflation rate. And there's a clear relationship between market bottoms, see the S&P here, and peak inflation. Peak inflation here, 1970, right? I marked it yellow, market bottom. Peak inflation in 1974, market bottom, close to a market bottom. Peak inflation in 1980, market bottom. And in each time inflation peaked, markets bottomed and then they raced higher. Sure, it was a choppy journey here in the mid 70s, but after the 1980 peak inflation and market bottom, equity markets raced higher. We may or may not have hit peak inflation. Many people are saying that we have. If we have hit peak inflation, empirical evidence would suggest that could be a good thing for future equity returns. And this backs that narrative up as well. So this is a U.S. stock market average return, and this is the S&P 500 from 1928 to 2021. And, this is rather simplistic, but I think it shows an important story where equity markets tend to do poorly or less well in rising inflation environments. When inflation has peaked and is falling, equity markets tend to do the best. And there's a lot of talk about rising rates and falling rates. And make no mistake, this conclusion is a bit misleading because these are about the same. These are very much intertwined. When inflation is falling, rates are likely falling. When inflation is high or rising, rates are likely going up. But falling inflation typically equals more accommodative monetary policy, more liquidity out there. So it's easier to access capital. Rates are lower, borrowing costs are lower for consumers and businesses. So that would make sense that environment where people are borrowing, seeking risk, would be good for financial markets. But the key here is inflation is very important. And certainly the Fed, market participants, investors are all watching this. And if we do get a period of falling inflation, empirically, that tends to be good for financial markets. Lastly, Howard Marks, if you haven't checked him out, he's one of the smartest investors out there. He writes a wonderful newsletter, and it's one of the few that I actually read. He's just a savvy investor. His newsletters are free. If you're serious about what some of the smartest investors on the planet are thinking, I would encourage you to check Howard Marks out. And one of the things, so we write a lot about behavioral finance and how to think better, which can lead to better investment decisions. And Howard Marks recently had a conference in London for his firm, Oaktree Capital. And he was talking about how many questions he got about the short term. So how bad will inflation get? How much will the Fed raise rates? Will that lead to a recession? How bad for how long? And I found it interesting. And Howard has a way of phrasing complex topics in simple terms. And that's really a sign of brilliance. But this is coming from one of the most respected and smartest investors on the planet. And this is what he said about those questions, which all relate to the short term. Most investors can't do a superior job of predicting short-term phenomena like these. They shouldn't put much stock in opinions on these subjects. Even when they get answers to these questions, they're unlikely to make a major change in their portfolio. The changes that they do make are unlikely to be consistently right. Thus, these things don't matter. Okay, so he's basically saying all of the Wall Street firms, all of the talking heads on TV, all of the smart sounding narratives don't matter. They say more about humans' appetite for seeking the illusion of knowledge. Like humans want to know what happens next. There's comfort in the illusion that someone knows what happens next. So there is a fallacy and a limitation to seeking out these opinions. And think about the last 2 years and go back and read previous Wall Street notes. And if that's not evidence to ignore a lot of these short-term forecasts and predictions, I don't know what is, because literally the last 2 years, no one saw any of this coming. And I talk about it a lot. I write about it a lot. These risks come and go. They're what I call temporary risks. An investor would do better to focus on the permanent risks that really matter. Things that you can control. Your spending, lowering your tax rate, lowering the fees that you pay an advisor, educating yourself, identifying your blind spots. If you've behaved poorly in the past, writing down your cognitive or emotional biases, creating a risk management framework, right? So if the stuff does hit the fan, how are you going to make buy and sell decisions? These are things that are way more important than the short-term ebbs and flows in the market. 90% of people focus on the former rather than on the things they can control. So for those that follow me, for those that read our blog, I'm beating a dead horse, but I really do believe this stuff. the last 2 years have only solidified that viewpoint. So I don't want to belabor this. The main point is, if the smartest people on the planet don't know what happens next, why are we trying to predict what happens next? Why are we seeking opinions on what happens next? Focus on what you can control, and that should lead to better outcomes for you in the long term. Thanks for watching. Thanks for putting up with my rant. Next month, we will be, well, I guess we have, the month of December is going to be our annual market commentary. So that will be a little more graph heavy, a little more in depth. Feel free to give us feedback or ask us questions, or if you want to learn more about how Pure Portfolios works with clients, drop us a line at insight@pureportfolios.com. Thank you.